Welcome to this week's Market Review. Today we'll dive into sector performance, identify the strong and weaker players, and explore how seasonality could influence a potential bounce in lagging sectors. We'll also touch on the lack of stock participation across major indexes, highlighting the Dow Jones 9-day losing streak, and analyze historical trends for some valuable takeaways. Let's get started. Now, looking at sector performance this week, the strength is coming from technology, with semiconductors leading by about a 1.3% gain for the week, and weakness is coming from energy. Once again, energy is down for the week, down 1.97%. Now, energy is trading near its 200-day moving average. It actually traded below that. So again, look for a bounce that could happen over the next few weeks. Dividend stocks like SCHD dropped 2.43%, deeply oversold now, whereas small cap stocks like the IWM Russell 2000 fell 2.45%, close to 4% for the month of December, highlighting continued underperformance. At the same time, the Dow Jones Industrial Average is down 1.75% this week. However, historical seasonality shows there's an 80% chance of a bounce in these particular areas as we approach the next few days and weeks. Let's remain optimistic and keep this in mind for potential recovery plays. Stock participation and breadth has been disappointing. Turning into the Invesco Equal Weighted S&P 500 ETF, RSP, the lack of participation amongst stocks is evident. The chart shows successive pullbacks of 3 to 4% being normal. However, we are currently in a downward channel. This reflects weak breadth, where most stocks in the index have struggled to contribute to gains. On a broader market front, the Dow Jones is on a 9-day losing streak. This marks one of the rare occasions of consecutive declines, often signaling oversold conditions that could spark a rebound. Taking a step back to look at historical breadth indicators. Top panel, the S&P 500 price is near all-time highs, just 0.6% below the peak. Middle panel, over the past 9 days, there have been more declining stocks than advancing stocks in the S&P. Bottom panel, only 17% of stocks are at a 1-month low, a sharp contrast to historical bear markets where this metric hit over 90%. These environments tend to be in the middle of a bear market, so it's very unique to see this type of setup very near all-time highs on the S&P. This suggests the current environment is less about panic selling and more about sector rotation, with growth names, particularly tech, megacap, regaining momentum for now. Lastly, as shown in historical S&P data, December's second half tends to bring stronger returns. Past trends indicate that the Santa rally and the January effect often kicks in after middle of the month. Today marks your second paycheck from December, which is also the middle of the month, offering a potential tailwind for the markets. Final thoughts, while breadth appears weak, we're not in correction territory yet, and we're not even close. Staying adaptable and data-driven is key. Let's keep an eye on evolving conditions as we close out the year. Thanks for tuning in, and don't forget to subscribe for more updates.